in focus. And let me welcome on board Kumar Rakesh to analyze what Motown has done so far. Kumar, hi, great to have you on the show. I think what stands out when you look at the Motown sales for the month gone by is CVs. They are the ones which have actually performed the best, right?
Hi, Aisha. Morning. Yeah. So CV has finally started performing, came to the party a little late. There's a lot of lateral data which we have been tracking, and that had started indicating that the demand environment is incrementally improving. If you're looking at the diesel demand, that has been consistently improving. The freight rate also has been holding up pretty well, and oil prices, diesel prices have been quite steady. So that tells us that the capacity utilization is improving while the cost structure of the fleet operators have been quite supportive. The obvious outcome of this should be that they should start buying more of commercial vehicles with improved capacity utilization and better profitability. There's also a support of really low base in the second half of the last fiscal year, especially these quarters. And you put all of those together, add the GST rate cut, especially for the lighter commercial vehicles, it starts showing up in pretty strong numbers that we are seeing.
Uh, Kumar, hi, this is Harsha. What is what's really standing out for you in terms of the numbers, and who could the biggest beneficiaries be of this GST rate cut, in your opinion?
So while festival was expected to be strong, at least from the stock price performance, if you see, a lot of that got priced in the first few weeks itself. And since then, we have been hearing from investors that how much of this is actually sustainable. Because for all we know, this could be a pull forward of demand. Customers who were planning to buy in November, December, essentially decided to buy during the festival season. And what the recent number, not just the wholesale number, but also the registration numbers that we have been tracking, is indicating that the strong demand which we saw during the festival season is holding up. We have done a lot of analysis on the price elasticity of the industry. We calculate that the price elasticity is about 1.6 to 2 times. That means 10% price reduction should increase volume by 16 to 20%. Something similar is what is showing up in these numbers. So this gives us a lot of confidence that this is quite structural and sustainable growth momentum that we have seen post GST rate reduction, not just a phenomenon which we would see usually every year during the festival season, but potentially holding on for the coming months and quarters as well. So that's a good sign that the stock price reaction that happened is very well justified. We would argue that there is more earnings upgrade left for many of the uh, names in the passenger vehicle industry specifically. And that brings me to your second part of the question, that what stands out from who's most to gain. We think some of the passenger vehicle companies like Maruti Suzuki, which is more focused towards the entry segment, where we are seeing pretty strong and healthy demand. More importantly, a recovery in demand. That's a segment which was struggling for several years. There's a much higher pent-up demand setting in that particular segment, and that can potentially benefit the most. Of course, there are a lot of two-wheeler companies as well who are benefiting. We are a little cautious because there is an overhang of ABS implementation. We want to get better sense of that, how that pans out in the next calendar year. Otherwise, GST would be beneficiary for two-wheeler names as well.
Okay, and Kumar, in terms of Q2 commentary, what really stood out for you among all the auto stocks in terms of whatever you heard in terms of the commentary?
Actually, commentary is quite guarded across most of the companies. If you see their guidance for the volume growth is much below than what the companies are reporting so far, or the data which we have been tracking is indicating. So actually, companies are looking at it far more cautiously than what the data is coming through. And that definitely stood out. Possibly we will start seeing in the coming months and quarter much more upgrade in terms of commentary, far more confidence in terms of sustainability of these growth. I would assume that the question that investors and we had in our mind, that how much of this is sustainable, possibly many of the companies also had this in their mind. But as the data holds up at the momentum which it is showing right now, if it continues to hold up, we would start seeing far more positive and optimistic commentary coming out from the companies in the coming quarter.
Kumar, the auto sector itself has been in overdrive, right? We've seen very good returns. I mean, except certain pockets. For example, a Tata Motors, and talking stock specific, hasn't really moved much despite the value unlocking and demerger, etc. But outside of that, M&M, Bajaj Auto has done reasonably well. Hero's been a fabulous mover this year. Uh, what next? How much of that rally, that re-rating is done, and how much could be in store given that the commentary is more muted and there could be upside possibilities to that commentary?
Yeah, first from the stock price performance, a lot of it has happened post GST introduction. Um, Investors and market generally is preferring now consumption stories over the capex stories, and understandably seems to be a policy shift as well in line with that. But what sorry, what is happening is that auto is one of the few spaces where the data is backing up that consumption is picking up. It may not necessarily be the same case with the entire consumption basket. And that's why we would expect far more consolidation, investors gravitating towards the auto stocks where the data is backing up the pickup in consumption story pretty well. And if these numbers continue to hold up, we would expect that to continue to show up in terms of the valuation re-rating that the sector has seen, potentially holding up to those valuation re-rating, in some cases potentially having more of re-rating. So that creates the first leg of the outperformance, further outperformance of this sector, holding on to these valuation re-rating or further re-rating. The second bit, which I was partly referring to earlier, is that we think that the consensus earnings upgrade is not fully capturing in the upside that we are talking about. 1.6 to 2 times of price elasticity, which I spoke about, implies about low teen to mid teen sort of a volume growth, incremental volume growth. On top of that, we would expect some margin expansion as well. And that starts translating in close to mid-teens to high teens sort of an earnings upgrade potential. We haven't seen that kind of earnings upgrade as yet in the consensus numbers. So that also leaves some bit of stock outperformance driven by further earnings upgrade, which happens as these numbers continue to hold up pretty strong. The earnings expectation numbers will keep on going up, and that should also support the sector.
Yeah, that's the thing, right? That the earnings upgrade hasn't happened yet. Stock prices, especially in sectors like auto, are already beginning to price that in. So, basis that, then, Kumar, what is your sort of top recommendation and the favored lot within autos?
So our topics are Maruti Suzuki and Mahindra, both in the passenger vehicle space. We have also liked Ashok Leyland in the commercial vehicle space. And a bit more cautious on the two-wheeler, as I was earlier referring, there is a regulatory change in terms of ABS implementation. If that gets implemented, there is a pretty high headwind for many of the two-wheeler names, and we would be a little more cautious in that space going into that event. Why Maruti Suzuki and Mahindra, despite the stock price performance, to your question? Partly because, as I was earlier saying, that we are pretty comfortable with the valuation re-rating these couple of companies have seen. We would argue that there is potential for higher earnings valuation multiple as well, because if we want to buy anything in consumption, these are some of the names which are showing strong growth. And hence, investors, if they are going to look at consumption stories, Maruti and Mahindra does stand out in that regard. The second part of that is the strong growth translating into strong earnings growth. Over the next 2-3 years, we would see these two companies delivering strong low teen to mid teen, at least that kind of an earnings growth, potentially higher as well. And we don't think all of that has fully priced into the earnings upgrade as yet. So both from the valuation perspective as well as potential for earnings upgrade, we see these two stocks standing out.
Thank you so much, Kumar, for joining us, giving us that perspective, and coming in and speaking to us about auto. Of course, it's been a pack which has been in focus on the back of the numbers, but outside of that, the earnings upgrades, really, that's the key takeaway for me. The earnings upgrades are yet to fully translate in this sector. So you want to keep your eye out on that.